Today we're going to break down how lower interest rates and increased U.S. manufacturing can turn into higher-paying freight, and we'll use real trucking examples and not some theoretical BS spin to explain it.
So what changes are we going to see at the Federal Reserve?
The presumed new Federal Reserve Chair has been nominated. His name is Kevin Warsh, and he is talking about ending what he calls a war on Main Street America. In trucking terms, that means the Federal Reserve needs to stop squeezing the trucking industry and other small businesses so damn hard with high interest rates. Kevin Warsh is highly experienced. He served as a Federal Reserve governor from 2006 through 2011, including during the 2008 financial crisis. At 35, he was the youngest appointee in Federal Reserve history. He's worked with billionaire investor Stanley Druckenmiller and has taught at Stanford Business School. Needless to say, Kevin Warsh knows what he is doing and is exactly what the American economy needs.
And when truckers hear interest rates, they usually tune out and stop paying attention. But that would be a big mistake because interest rates decide who can expand their operation and pay better wages and who can't, and who in the end goes broke. A lot of folks don't understand that the trucking industry is actually a credit-based business. Trucking companies don't get paid for upwards of 30 to 90 days after making a delivery. And sometimes they get stiffed and not paid at all, yet they still have to put fuel in that truck and pay that driver. That's where the credit comes into play.
That's the key, Bernie. High interest rates hurt everyone. They hurt a trucking company's ability to buy trucks, add drivers, and chase better freight. When carriers can't expand, freight stays tight, which then causes shipper rates to stay low. High interest rates constrain small businesses by significantly increasing borrowing costs, tightening cash flow, and reducing customer spending. The higher cost of capital funding slows expansion, limits investments in new equipment, and makes financing harder to secure.
How will lower interest rates serve to help truck drivers?
Let's break this down in simple terms. Most trucking companies, especially small fleets, need to borrow money. They borrow money to purchase new trucks, to buy new trailers, to fund fuel credit lines, for insurance deposits, for needed shop equipment, and for parts and supplies.
And when borrowing interest rates are high, those monthly payments going out will eat profit alive. So instead of adding new trucks to the company or paying drivers more money, companies are forced to sit on their hands and tread water in order to survive. Hence the reason over the past 4 or 5 years, we have seen so many trucking companies going bankrupt or going out of business altogether.
So are you sitting there wondering exactly how truck drivers will benefit when interest rates come down? In the simplest terms, when borrowing money gets cheaper due to less interest being charged, carriers can then add new trucks and new trailers to their fleet, which then allows the truck company to go after contract freight instead of living load to load on the spot market with freight that came from freight brokers. This in turn means the trucking company is making more money per load, which then allows them to give their truck drivers a better wage and better benefits. Let's say a carrier is stuck running spot freight at $1.90 a mile because they don't have the cash flow to grow. They'd love to lock in a contract rate of $2.60 a mile for that lane, but that contract would require the trucking company to add on an additional 2 trucks. In this example, high interest rates would short-circuit the trucking company's ability to grow, add on drivers, and increase pay and benefits to their driver workforce.
With high interest rates, the math just doesn't work. Trucking companies already operate on a thin profit margin. Grab a pen and paper and add up the cost to run the truck you drive over the course of 1 month. Write down the total cost for each category. Add in the truck payment cost, the fuel cost, the money spent on supplies for the truck, the insurance cost, and the cost of driver wages and benefits that have to be paid. And don't forget, money has to be put aside to cover the occasional tire blowout or road repair. Once you have a total, divide it by the average number of miles normally run during a month. This is the exact method that responsible trucking companies use to figure out what their break-even truck cost is per mile.
You are exactly right, Bernie. Adding on to what you have said, for the sake of using round numbers, let's say the total cost to operate that single truck per month is $20,000, and the expectation is to run 2,500 miles a week or 10,000 miles over the course of the month. Do the math and the break-even point works out to be $2 a mile. If interest rates drop and financing costs come down, suddenly buying those 2 trucks we spoke about earlier makes sense. The trucking company in that example could lock in the contract, and now the driver isn't chasing junk freight. They're hauling steady loads that pay more every single week.
Lower interest rates boost truck driver pay by stimulating economic activity, leading to higher consumer demand for goods and subsequently more freight volume for carriers. Increased freight demand will also raise shipping rates, both spot and contract rates, allowing drivers, especially those paid a percentage of revenue, to earn more per load.
Why manufacturing means better pay for truck drivers.
Now this is the second half of the puzzle. Lower interest rates don't help unless there's freight demand, and that's where manufacturing comes in. When factories open or expand in the US, they don't just create jobs, they create layers of freight. These new factories will need trucks to deliver raw materials to them. These same factories will then need trucks to deliver the finished goods. There will also be a need to move parts between plants. New manufacturing plants are the lifeblood of trucking companies. For example, John Deere is building excavators in North Carolina for the first time in over 50 years. And the Treasury Department noted that for the first time in 26 years, the United States produced more steel than Japan. Kevin Warsh's nomination to head up the Federal Reserve is a clear signal that the economic framework that created years of trucking devastation may finally be changing.
Manufacturing freight is a different animal altogether. Plants need reliable service, on-time delivery, and repeat lanes. These plants, without question, will pay for the consistency that a good carrier will give them. That's why manufacturing freight tends to be contract-based, not random spot loads. And contract freight is where drivers see steadier miles and better weekly money.
How this puts more money in your pocket.
There's a chain reaction that takes place that drivers need to understand. With lower interest rates, trucking companies can expand their fleet, which creates more jobs. Lower interest rates give a trucking company the ability to chase higher quality freight. Lower interest rates will bring about more manufacturing, which will lead to more consistent, better paying loads. And when freight demand rises, carriers have to compete for drivers, which then pushes driver pay up. Let's say a driver is grossing $1,200 a week on inconsistent spot freight. Same driver, same miles, but on a manufacturing contract lane would probably make somewhere between $1,600 to $1,800 per week because the freight pays better and runs steady.
Here's something else people don't talk about. Manufacturing freight usually stays domestic. It doesn't rely on ports, foreign delays, or overseas chaos. That keeps the freight inside the U.S. trucking market, where American drivers benefit instead of being undercut by the global supply chain. Well, my friends, that's it for now. We hope this information will help get the word out. Help is on the way in the form of lower interest rates. Keep the shiny side up and the rubber side down. We are trying to grow this channel to help truck drivers along with educating the general public. You can help us out by smashing that like button and the notification bell. Remember to subscribe and share this with another driver.
Protect your load, protect your rig, and protect yourself. Leave us a comment below with your thoughts and ideas about this topic. If it's a good idea, we will share it with everyone. Subscribe for more trucking truth, and together we'll keep hammering this issue till somebody listens.